Hey everybody, this is Halstead and Michael Klenck with REH Wealth. Today we want to talk about how your money is protected at banks and at brokerage houses. There's been a lot of news lately concerning bank failures, specifically the Silicon Valley Bank, and how they were potentially going to fail, and how a lot of their clients' money was at risk for people who were above the FDIC limit. So I've got Michael Klenck here with me today. He's going to talk about how your money is protected through banks, through FDIC insurance, and also through brokerage houses through SIPC insurance. So Mike, what can you tell us about how your money is protected?
Yeah, well, thanks, Ray. This is very timely because there's been a lot of publicity recently with the bank failure of the Silicon Valley Bank. And basically what happened there was they couldn't meet the demand of their withdrawals, so the regulators had to step in and provide protection to the depositors up to the FDIC limits, and then they felt that it was in the best interest of the banking industry and the economy to actually extend coverage beyond the limits. So we've been getting a lot of inquiries, is my money safe at the bank I bank with and at the brokerage companies. So at a bank, your deposits are covered by what's called FDIC insurance, Federal Deposit Insurance Corporation. So if you're banking at a member bank that has FDIC protection, you have coverage up to $250,000, and that coverage is per depositor, per ownership category, per institution. So it's critical if you have a large amount of cash to make sure you have the protection that you think you may have. And basically, some examples of that, if you have a $200,000 individual savings account, you're going to be protected because you're under the $250,000 limit. Another example, if you have a joint savings account, husband and wife or whoever it may be, and you have $400,000 in that cash account, you'll still be protected because each individual person has up to the $250,000. If you have an individual account, $200,000, and then an IRA at a bank that is invested in bank deposits, say that IRA is $250,000, you'll be covered under both of those accounts. Now you got to be concerned if you invest through a bank in the bank brokerage company and it's in mutual funds or annuities or stocks and bonds. FDIC protection does not protect against those types of products. So it could get pretty complicated to make sure you have the correct coverage if you have a lot of cash on hand, which a lot of people have right now, either from pulling money out of the stock market, being concerned, selling businesses, selling a house. So make sure you talk to your banker, your CPA, or your financial advisor to see if you have the protection that you think you have. Another way to do it is on the FDIC website itself. There is a coverage calculator. You enter in your account information and it will tell you what protection you have. If you're fortunate to have a large amount of cash on hand for whatever reason, there are some programs that we have used in the past. One is called CDARS, and that's an acronym for Certificate of Deposit Account Registry Service. They can provide protection up to $50 million, and what that service does is it will spread your money around multiple financial institutions, keep track of it, make sure you're protected under the individual accounts. With that service, naturally, there's a cost to doing that, but they do a good job.
So what about for brokerage houses? How does the insurance work for a brokerage house?
Well, that's a good point because it's a little different than FDIC protection. In the brokerage industry, there's what's called SIPC, Securities Investor Protection Corporation. It was created under the Securities Investor Protection Act. And it's similar to FDIC insurance, but there are some differences. They provide up to $500,000 of coverage. Of that, $250,000 could be cash. The way they define the accounts that are covered is a little different. It's basically per account, per separate capacity, per person. But so if you have an individual account, they'll cover up to $500,000. If you have an IRA account, $500,000. If you have a joint account, going to be up to $1 million. A lot of firms purchase excess coverage, so they may extend that $500,000 to a greater amount. But one important thing to keep in mind is that it does not cover market loss to your securities. So if you buy Apple stock, it goes down, the bank fails, or the brokerage fails, it doesn't cover that loss due to market performance.
Right.
But there is a big difference between the coverage of banks and brokerage companies. When you give money to a bank, say you give them $1,000, that goes on their balance sheet as both an asset and a liability. That bank then takes that money and goes out and invests it, usually in treasuries, conservative investments, may loan it out, and they have control over that money. When you give $1,000 to a brokerage company and you instruct them to invest that, say in Apple stock, they do the transaction, and then those shares of Apple stock are held at a third-party custodial company. So the brokerage company doesn't have access to those shares. If they have a shortfall that month to pay the light bill, they just can't dip into your shares. So
Right.
The key to it is to make sure that whatever brokerage company, investment advisor you have has your investments held at a custodial firm. Some of those large custodial firms are like Pershing, State Street. You never want to have an investment advisor be both your advisor and custodian. So that's very critical there. If an advisor is trying to keep control of your money,
Yeah.
call somebody.
Yeah. Awesome. Well, really good information, Mike. Certainly appreciate it. So, for our clients out there, if you have a substantial amount of cash with banks or investment houses and you want to make sure they're protected and you're not sure, feel free to give us a call and we can help you understand that.
Yeah.
Thank you.